here's a fact that sounds made up, but it's actually completely real. The US government owns something like 8,000 tons of gold, allegedly. We don't know if this is what's called unencumbered gold or if it's still there, but that's what the official numbers say. Could be a lot less, could be a lot more. But on the government's books, that gold is not valued at the market price. It is valued at a price set by law back in 1973 and was never updated since. That price is $42 per ounce. Gold is obviously trading around $4,000 per ounce. So officially on paper, the United States values all of its gold at about $11 billion. In reality, at today's prices, that gold would be worth closer to $1 trillion. It's $1 trillion gap. It's basically hidden by an accounting rule from the Nixon era. So how the US could fight this is with just the stroke of a pen. The US could just revalue that gold and update the official price from $42 to something closer to the market price. Now, the moment the US does that, more than $1 trillion in value would appear on the Treasury's books. It's money the government could use without creating or issuing a new bond. In fact, the Federal Reserve has actually published research on this idea.
That $1 trillion accounting gap Andre just walked you through is the piece nobody in mainstream financial media wants to touch. And here is why it matters right now, instead of 5 years ago. That gap has been sitting quietly on the Treasury's books since 1973. 52 years of nobody caring. But in the last 3 months, something changed. 4 of China's biggest state banks, ICBC, Postal Savings Bank of China, Ping An, and China Guangfa, all pulled the plug on retail paper gold trading inside the same short window. Central banks around the world are buying physical gold at the fastest pace in recorded history. Andre walks through his theory that gold has been artificially suppressed by paper markets for decades, and China is now quietly building the system to end that suppression. Hit like so this decode reaches more people? Then watch the next chunk.
So the official reason is gold is volatile, retail traders are getting hurt, and big government has to step in to protect them. Now, the unofficial story, though, is probably what's actually happening, which is the battle for real money and what that money should be worth. Right? Think about what China is really shutting down. They are getting rid of margin trading. They're getting rid of the leveraged deferred contracts, the paper gold. Basically, the easiest way to understand it is they are getting rid of the speculation, the gambling. But physical gold, that's all good. They could still buy and sell that. They're not stopping people from owning gold. They are stopping people from trading the paper claims against gold. Okay, so why is China doing that? The theory says it's because the real price of gold should be way higher than it actually is. But the reason that it's not is because it's being manipulated and suppressed by the paper markets, and it has been for decades. So in order to have what's called real price discovery, in other words, in order to figure out what something's really worth, you need to first shut down people's ability to gamble on the price of it. Now, if this were true, we'd probably see China, as a nation, start to buy a lot more gold than usual. And that's exactly what they've been doing. In May of this year, they bought 163 tons of gold, the most since March 2024. And that's not just true of China. That is true of all central banks around the world, which have been buying way more gold. In fact, as much as 15 times more than they've been telling us. It makes sense, right? Which is also why the Chinese government is launching a brand new gold clearing and settlement system. It's a system that's designed to make China, not London or New York, but China, as the place where the price of gold actually gets set. Now, once you put all of this together, central banks and nations secretly buying gold and taking steps to get rid of the paper markets and building the settlement hub there, it all starts to make a lot more sense.
Everything Andre just said is verifiable. The central bank buying numbers, the new Shanghai Hong Kong settlement architecture, all of it. But the part that turns this from a China story into an every single viewer story is what he covers next. Because if China's move works, the United States has to answer it. And the answer being seriously discussed inside the Treasury and the Federal Reserve right now would rewrite what a dollar is worth. Watch this.
The Treasury secretaries talked about monetizing the asset side of America's balance sheet.
Within the next 12 months, we're going to monetize the asset side of the U.S. balance sheet for the American people. We're going to put the assets to work.
There's also a proposal floating around from an economist named Judy Shelton for a 50-year Treasury bond that you could redeem in either dollars or physical gold. Now, what that would do is it would make the U.S. Treasury bond partially backed by gold again. The exact same trick that China is doing with the yuan. So that is the West's answer to the East. If China is going to anchor the yuan to gold, then the counter is, okay, fine, we'll just do the same for the dollar, right? And that is also why some people out there believe, and this is big speculation here, but that this reevaluation could happen sometime in July, maybe July 4th, right? America's 250th birthday, where the US revalues its gold and launches that gold-backed bond as kind of a monetary declaration of independence.
Think if on July 4, 2026, which is going to be the 250th anniversary of our nation's founding, Treasury offered for the first time since 1971, when President Nixon closed the gold window and ended any kind of gold convertibility for the dollar, you would be establishing a link between the US dollar and gold.
Here's what Andre hints at but does not fully spell out, and it is the piece that matters most for anyone holding US dollars. If this thesis is even partially correct, the winner is whoever holds physical gold and the currency that ends up backed by it. The loser is anyone holding paper dollars with no hedge. 5 takeaways. 1. This is not a go buy gold today story. Gold tripled from its 2020 lows, and central banks have been front-running this move for 3 years. If you are just hearing about it now, you are late to the trade at these price levels. The smart money accumulation window was 2021 through 2023. What you are seeing on charts today is the tail end of a repositioning that already happened at the sovereign level. Chasing gold at $4,000 hoping it goes to $20,000 is a retail trade against players who bought in at $1,800. That is not a trade you win. 2. The sharper question is what happens to your paycheck's purchasing power if the US devalues the dollar to keep pace with a China-anchored yuan? That scenario has Fed research behind it. The current Treasury Secretary has openly discussed it on camera, and Judy Shelton's 50-year gold-backed Treasury bond proposal is circulating in policy circles right now. Whether it lands on July 4th, 2026, or 2 years later, the trajectory is real. What that looks like for regular people is not a stock market crash or a gold price explosion. It looks like groceries slowly costing 15% more year over year while your wages stay flat. It is inflation without a headline event. That is the actual risk to prepare for, not a movie-style dollar collapse. 3. This is where slick finance parts ways with most of the gold versus Bitcoin crowd. If China succeeds in re-anchoring the yuan to gold, the case for Bitcoin as a dollar debasement hedge gets stronger, not weaker. It validates the thesis that unbacked fiat needs an anchor, and the market will find every anchor available. The people telling you it is gold or Bitcoin are missing the pattern. Both assets are betting against the same thing, which is unlimited central bank money printing. In a world where China anchors the yuan to gold, the smart hedge portfolio holds a piece of each, not all of one. Number 4. Here is what to actually watch instead of the daily gold price. Signal 1 is whether Hong Kong's physical gold vault expansion actually delivers the build-out of 200 to 2,000 tons on schedule. Signal 2 is whether the Treasury Secretary follows through on his own on-camera language about monetizing the asset side of the balance sheet within 12 months. Signal 3 is whether the Shanghai Gold Exchange announces new bilateral commodity settlement deals denominated in yuan, especially with Saudi Arabia, Russia, or Brazil. Signal 4 is whether the U.S. actually pilots the Shelton gold-backed Treasury bond. Any two of these landing inside the same 6-month window means the theory is playing out. None of them landing means it was speculation. You do not need to guess. You need to track. 5. The historical parallel matters. In August 1971, Nixon closed the gold window and unilaterally ended dollar convertibility to gold. The U.S. did that from a position of strength to keep the dollar dominant. What is happening now is the mirror image running in reverse. China is opening its own gold window from a position of gaining strength, and the West is being forced to respond. History does not usually rhyme this cleanly, but when it does, it pays to notice. Honest disclosure. Nobody outside a few central bank rooms knows exactly what is happening. Andre is presenting a theory. It fits the data, but data fits multiple theories. The innocent reading, that China is protecting retail from volatility and central banks are just diversifying reserves, is also consistent with what we are seeing. There is also a scenario where the U.S. simply prints its way through this and dilutes China's dollar holdings before they can offload them. That would be ugly for everyone, but it is not off the table. What is not consistent with any innocent reading is Hong Kong expanding physical gold vault capacity from around 200 tons to over 2,000 tons. You do not build a 10 times bigger vault for a paper casino. You build it because you plan to settle real gold. That single fact is the tell. The mistake most retail investors will make in the next 24 months is treating this as a gold trade. It is not. It is a signal about the reliability of the currency your paycheck arrives in. The move is not betting on a specific gold price. The move is making sure whatever you work for today still buys what you need in 5 years. This is editorial analysis, not financial advice. If you are making moves based on this, talk to a licensed advisor about your specific situation. Thank you for watching Slick Finance. Drop your take on where gold goes next in the comments, hit the bell so you catch the next decode, and if you want more of these breakdowns, subscribe.